Well, it's the start of fall, which means crisp autumn mornings, the return of football, and reviewing your investment portfolio. On today's Trending, we are providing you with the UBS Chief Investment Office's latest market outlook and our investment views.
We're going to highlight two of CIO's top investment ideas, also known as messages in focus, and what we find interesting about them. A conversation well worth your time right here on UBS Trending.
Hi everyone, and welcome to UBS Trending. I'm Dan Scansaroli.
And I'm Michelle LaLiberty. We're going to get straight to the point with some insights about the latest House View report. The two messages in focus that we'll be discussing are get in balance and picking leaders from disruption. Why don't you kick it off first, Dan?
I'm going to talk to you about three updates that I found interesting in the new message in focus, get in balance. Number one, while August data showed a slight uptick in headline and core CPI, inflation has come down sharply from its 9% peak last year to 3.7% as it heads towards that target that the Fed has of just 2%. Simultaneously, labor markets continue to cool enough to reduce upward pressure on inflation, but not enough as to provoke fears of recession. This has led the Fed to pausing its rate hikes in September, and they are likely to hold or hike one last time in November. Just a few months ago, a soft landing seemed a challenging task. And while a soft landing is not yet assured, the economy looks much closer to being in balance, and we believe the economy will remain resilient and avoid a recession over the next 12 months, albeit with a high degree of equity and rate volatility as the restricted levels of rates take effect. This is an environment where it is essential to balance equities, bonds, and alternatives to increase the dependability of portfolio returns and increase exposure to a variety of return drivers that can help lower overall portfolio swings. Number two, U.S. corporate earnings beat expectations in the second quarter, and fundamentals in the equity market are in better shape after gains largely driven by valuation expansion. Now, profit dynamics are more supportive with an earnings growth in 2024 expected to be at 9%. However, high equity valuations require investors to be selective while rebalancing away from growth stocks which have outperformed and towards stocks which lagged and are presenting better valuation and catch-up opportunities. With the S&P 500 up over 13% year-to-date after a narrow rally in the top 7 tech stocks, the average stock in the S&P is up only 2.5%. In the next 6 to 12 months, we expect global equities to offer 8 to 10% returns with flat markets through year end. To remain in balance, rebalancing your portfolio is a critical tool to keep risks in check and capture catch-up trades after large rallies in certain areas of the market. Number three, we believe bonds are back. It's time to shift from cash and lock in rates as they peak. Returns on cash is likely to fall from here, while bonds are positioned to drive both income and a potential for capital appreciation as the Fed ends its hiking cycle. Bond performance has been muted so far this year, but as rates peak, we favor bonds over equities. Investors should rebalance away from cash to lock in current yields that have not been seen in the bond market for over 16 years before they fall. The 5-year Treasury currently offers a 4.6% yield. We see limited downside in quality bonds as it would take over 100 basis point increase in yields to wipe out a year's worth of income. Given that the Fed is near the end of its hiking cycle, we expect a fall in rates next year, which would provide a mark-to-market appreciation in prices while offering balanced equities in an economic slowdown for those who take on the duration. Michelle, over to you.
I'm going to talk about three key themes that will help you position your portfolios for disruption. Number one, technological disruption. I'm sure you've heard about AI already this year, but technological disruption is going to shape the investment landscape for years to come. Semiconductors have been the early beneficiaries, but from here, we think software and internet companies looked well positioned to monetize their investments in artificial intelligence. Second, the energy transition. The energy sector is no stranger to disruption. New market participants in the clean energy space are reshaping the industry, while traditional energy companies are exploring new technologies like carbon capture. The energy transition is going to take time, and in addition to liking the energy sector as a whole, we also see longer-term opportunities across the entire green tech supply chain. Finally, healthcare. Outside of the AI buzz this year, headlines have also been dominated by the innovation happening in weight loss and obesity treatments. Not only will these currents drive near-term opportunities within the healthcare sector, they're also symbolic of a broader trend. As global populations age, the healthcare sector looks ripe for disruption, and we've identified a number of long-term themes to help you take advantage, from health tech to medical devices.
You know, Michelle, I see this new myth as really related to getting back in balance. One of the core themes as we look at that is having a diversified set of factors in the portfolio, whether it's healthcare on the value side or AI on the growth side, or even looking to private markets where you can get an additional premium in the AI space. You know, those diversified return drivers really are what counterbalance those downside risks and can smooth the path along the way as we see the economy change and the opportunities.
Absolutely, and it's important to be balanced within themes as well, so diversification is always critical. But that's all we have time for today. Dan, great to have you in this conversation with me, and thank you all for joining. The monthly CIO House View is a guide providing asset allocation and macro commentary, and the House View is the essential publication for you to find our latest thinking. For more information, visit ubs.com/views, and also visit ubs.com/MIF for Message in Focus.
UBS Trending is on social media. Follow us at Instagram at UBS Trending for content that you won't find anywhere else. You can also check us out on LinkedIn, Facebook, and Twitter for more. As always, if you have any questions about your portfolio, please speak with a financial advisor. Until next time, I'm Dan Scansaroli.
And I'm Michelle Liberty on this special report. Have a great day, and remember to keep your eyes on what's trending.